Why are we seeing government after government after government replaced? Because in the 2020s, people realized that even if they don't know the macroeconomic statistics or they don't know the charts and see GDP that goes sideways, they can feel the results of that. They can feel it even more this time because they know they've been impoverished. I think that's the real overriding point for the 2020s. And you can't just impoverish people and expect it to go well. I don't know why people think that's the case. Yeah, but that seems to be the dominant narrative that, oh, governments did it. They found the right way to interject just enough money into the economy and redistribute what was needed to be redistributed to keep it from falling off. Well, the economy didn't fall off in terms of output, but it did fall off in terms of purchasing power of consumers and businesses. And that's what they're pissed about. Look, we have a broken monetary system that broke down in August of 2007. It's never been fixed. And nobody even knows it's broken because everybody's been dazzled by QEs and Fed policies and fiscal stimulus and everything else. And so nobody's stopped and looked at the original sin.
What's the bond market telling us? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Jeff Snider, founder of Eurodollar University. Hey, Jeff. It's great to see you.
Hey, Maggie. Thanks for having me back. Good to see you again.
So we have some really interesting dynamics in the market, and I'm always curious to get your take because you're always looking at sort of different things and have a much different perspective, I think, than some of the chatter that we see on X and some other places. Sometimes turns into groupthink. And so I want to run a few things past you. And one of them is that we have the S&P at record highs, but bond yields seem to be drifting lower. And it seems like a relentless march for U.S. equities, but more volatility for bonds. So it doesn't seem like both of those markets or both of those things can be right. So I'm wondering what you make of it and in particular, what you think the bond market is signaling.
Well, if you start with the stock market, I think stocks are pretty simple. What's the saying that Mike Green came up with? If cash comes in, then buy, right? So the stock market it's going to go up. Everybody puts their savings in it. So stocks are going to go up unless and until the market perceives a recession, right? That's the only time where you see stocks go down and stay down for any prolonged period of time. That's the only real interruption in the upward trend. At least the modern stock market that goes back into the early 1980s, which is when everybody started to transition their savings into stocks. So essentially, the stock market is looking for what it perceives of as recession risk. So you got to have a negative GDP, got some negative payrolls, and some of the main statistics that look like a recession that have looked like other recessions in history. What the bond market is saying is that there are other types of recession, not just the traditional V-shaped pattern that you're often familiar with. So stocks are looking for that, and bonds are saying you have a very different growth paradigm than what the stock market is looking at. So stocks are just, hey, we don't see a recession, buy. Bonds are like, well, there's other types of downturns and periods of stagnation, if you want to call it that, where we're in one of those and have been for the last couple of years. But because it doesn't look like a traditional recession, the stock market is completely unbothered by it. And stocks are, if everybody believes we're not in a recession, then everybody's going to buy stocks. So I better buy stocks too. So it's sort of a different dynamic, but it's not really because the cycle doesn't look like a traditional recession. So it's easy to ignore all of the signals that suggest that it isn't a typical recession signal.
So what is happening with the economy? Is it in a recession? Is it heading into recession? Or is there some other issue that's a problem that's worrying at bond investors? What are they looking at?
See, that's the thing. It's the term recession. People don't like that term because they think it looks, the recession that we're used to in the post-war era up until 2007, that's what we have in mind for a recession. So if it doesn't look like a recession, it can't be one. Right. So the assumption of the stock market is if it's not a recession, then buy stocks. And the assumption in the interpretation of the economy is if it's not in a traditional recession, then it must be a strong and resilient expansion. And like you said, there's a whole spectrum of possibilities where it comes to the macroeconomy. And what we've seen for the macroeconomy, especially outside the United States, where this pattern is much clearer, is essentially the economies stopped growing. Back in 2022, in real terms, when you adjust for prices, volumes just stopped. And so it's been sideways for two and a half years now, going on 3 years in a lot of places, which is that growth? Is that recession? What is that? So it's a very difficult interpretation for people to make when they're conditioned to believe that recessions only look like this one thing. It's not one place or another or one economic variable or another either. You see the sideways trend almost everywhere. You see it in, the best example is GDP in places like Germany or Australia is starting to look like that. New Zealand, South Korea, it's over and over again. You can see it in the US statistics too. Industrial production, growth until to 2022, and then sideways to slightly lower since then. And because it goes back and forth during this 2-year period, every couple of months, the statistic will perk up and people say, okay, the economy's doing okay. And then it will fall off again. And it's like, okay, is this a recession? Then it will pick back up. And so it just goes back and forth in short run variations. But overall, it goes nowhere. And what people miss about that is that when you go nowhere for more than 2 years, that's an enormous contraction all its own. So what has happened is, you've got this difficult interpretation, but it has very real consequences in the macroeconomy. And a perfect example of that is the U.S. labor market. And again, this is another perfect example, not just of the sideways, not growing economy, but also the difficulties interpretation. Because when you hear people talk about the labor market, it looks right. I mean, everybody says it's strong. Right. Payrolls are growing. In fact, payrolls picked up in the last part of last year, and to an extent in January. They disappointed a little bit. But you look at the payroll numbers from month to month, and it doesn't look like anything is wrong. But that's the wrong comparison to make. What most people don't realize is that even the payroll numbers are 5 million short of a recovery, which means, yes, they're growing every month, but they're not growing nearly enough to generate what would actually be consistent with a recovery. Because back around 2022 and 2023, the trend in payroll growth started to slow down materially to the point that it was no longer enough to generate a full and complete recovery. So you have slow growth in the macroeconomy globally that's more visible. You've even got too slow growth in the U.S. labor market, but it doesn't look like a recession. And because it doesn't look like a recession, or at least look like the recession everybody pictures of a recession, you have this, okay, the economy must be strong. And the bond market is saying, no, it's not a recession that you would recognize, but it is still a period of, at the very least, low growth and inflation, which is what low interest rates are all about. They're growth and inflation expectations. And that's what the data is actually showing.
That's so interesting you say that, because there has been this disconnect, and you have people who are out there who come up with great statistics and have been saying that underneath things are weak, and then they just seem wrong because it doesn't seem like it's confirmed by all these other things. And so it's kind of creating confusion, because you read that and you say, okay, that makes sense. And then, there's another part that seems like it's hot, like the service side of the economy, travel and leisure, all these other things. Has the fiscal spending just been sort of keeping us afloat, at keeping some part strong, all of that fiscal spending that we saw, and really we're still sinking? It's just been furiously keeping the U.S.'s head above water. Is that why it feels, or it seems like there's strength around?
Yeah, that's part of it. But a lot of it just goes back to the fact that we have a very unique set of circumstances here in the 2020s. I think that's one of the things that people lose sight of, is that we shouldn't look for a traditional kind of recession, because we have a very unique case here. Yeah. You've got the pandemic, the lockdowns, the price illusion, the supply shock, all that stuff happened in a relatively short period of time. It created massive distortions all throughout the economy that make it largely unrecognizable, and therefore not really comparable to historical periods. So that's one problem that we already started with. We've got a very unique set of circumstances. What you just said, Maggie, is also part of it too. Part of those distortions was a huge, huge increase in government activities, a whole bunch of stuff. We had, government transfer payments early on, government spending that kept up. In the United States, government hiring, jobs. You look at the jobs for governments, various levels of government, especially at the state level. It's like a 45-degree angle going up, regardless of circumstances. And that goes back to the the Inflation Reduction Act in 2022, 2023. So yeah, government distortions. I think that's the overriding theme, is unique circumstances and distortions, which make it difficult to interpret what's happening in the real economy through the lens of the traditional cycles that we're used to. So you have all of these different things that are playing out in different ways. And if you're looking for something like 2001, for example, which was a pretty shallow recession, but it was a recognizable recession, you see a lot of similarities, but too many differences that you can point to it and say, yes, we're following this template into a recession period. And so the market, the bond market, and a lot of other markets beside it were saying, okay, yeah, it's not a traditional recession like 2001. In many ways, it's worse, because when you get into, as I said, a multi-year period of stagnation, or whatever you want to call it, That's actually worse than having a recession that for a couple of quarters, the economy contracts and then it starts to recover. You go sideways without growth for 2.5, 3 years. Some of these statistics are so far behind their trend line. It's in the same vicinity of something like 2008. But yet, because you don't have negative number after negative number after negative number, people think, well, nothing's wrong. It's still nominally positive.
Yeah, and you don't see the sort of dramatic fallout that we saw and the reaction in the financial markets. So you mentioned inflation. What about, this is another point that you have, these divided camps. What about the analysts who say, warning against a premature pivot by the Fed, saying, listen, tariffs and deglobalization is inflationary. We're entering a different period. Are we in a different period now?
No, I mean, first of all, it's not inflation. Inflation is a monetary driven thing, and it's not really about interest rates at all. In fact, if we saw inflation coming, the bond market would tell us by interest rates rising. That's another thing that people get wrong, is the interest rate fallacy, as Milton Friedman called it, where interest rates go down during tight money periods and interest rates go up during inflationary periods. Like you go back to the 1970s, during the Great Inflation, what did interest rates do? They went up. They went up, and up, and up, and further. During the 1930s, the clearest case of deflation and depression we have, interest rates went down and stayed down. So if we were seeing something that looked like legitimate sustained inflation, we would see bond yields react to it and they would start to rise.
And stay up, because some people think when we've seen that volatility, we've seen them go up and down, and then they look like they're creeping above 5 and they're heading a lot higher, and then they go down again. And so people have been like running from one side of the ship to the other because they keep thinking inflation's coming back.
But yet, despite that short-run volatility, those fluctuations, which are perfectly normal in the marketplace, long-term interest rates in the United States, in Canada, in Germany, in Europe have been basically sideways since October of 2022, which not coincidentally is right when this sideways trend in the real economy showed up. So when the economy started to exhibit this weird recession type of pattern, that's when the bond market said, yeah, not only did the bond market and interest rates kind of go sideways from there, they leveled off. They leveled off in defiance of central banks who were still hiking rates and still talking about higher for longer and inflation risk. And the bond market said, nope, that's not happening. You can see it actually happen. You put the chart up of, say, German yields against the ECB. October 2022 happens. Bond yields start to go sideways. And then March of 2023, the banking crisis that everyone has forgot about. That's the moment when yields completely stopped following central bank rate hikes and went sideways from there. And so did the real economy. So ever since 2022 and 2023, that window between what was called the gilt crisis in September 2022, which wasn't, it was a global collateral crisis, and the banking crisis that showed up in March of 2023, that period was a transition period for the marketplace as well as the macroeconomy. So yes, yields have gone back and forth between them, but historically they're in a pretty narrow and pretty steady range, which tells you the market overall, despite the fluctuations, is thinking low growth, low inflation expectations. And even the tariffs and oil price spikes they contribute to that low growth and low inflation, because in this environment where you don't have genuine economic growth, any increase in prices, while it looks inflationary in the short run because it has a direct impact on consumer price numbers, it's actually disinflationary over the long run because it requires consumers who don't have the purchasing power nor the income potential to pay for it. A perfect example we just saw in January, auto insurance. For the second January in a row, auto insurance premiums skyrocketed. That looks inflationary in the short run because it makes the CPI stronger in the near term. But what is the macroeconomic effect of that going to be? It's not going to be inflationary because it's going to force consumers to have to pay higher auto premiums, which means they're going to have to take spending from someplace else. So in the long run, it's harmful to the economy. It becomes more disinflationary. It's not the 1970s style inflation because you don't have the money and credit creation. Instead, it's the same type of behavior that has led the macroeconomy into this weird sideways pattern to begin with. That's one of the reasons why it's into this, no growth environment, is because as prices rise, it just destroys more and more demand.
Yeah. Again, which matches up with a lot of the things in particular that Danielle DiMartino Booth points out, because a lot of that's consumer related and you can see the pain, but then, then people are wondering why it doesn't show up. Do you think that this is just a period that it has to work through that's going to take a long time, or did something break and we're stuck in this low growth sort of, weird environment where we can't seem to get the levers moving again?
Yeah, well, this goes back to 2008. We've never recovered from that one. So, I mean, and in many ways, if you think about it in big picture terms, you had a lack of recovery after 2008, which most people miss. And in fact, the entire decade of the 2010s looks exactly what we're talking about here, where it was more sideways stuff. It didn't look like a traditional recession. You didn't have lots of negative numbers, but you had way too low levels of growth. That meant that we got further and further and further behind, fewer and fewer people working, more and more angry people, which is another element to all this too. Why do we have governments falling around the world? Because the macroeconomy sucks. And for several years, people, governments that were in charge would refuse to even admit the possibility the macroeconomy wasn't performing, except for, saying it's massively strong and it's on its way to a recovery. So you have the 2010s, then along comes a pandemic where governments shut down massive portions of the economy, destroyed businesses, destroyed a whole bunch of capacity and potential. So you've got the bad 2010s, then something really bad happens in the 2020s. Are we really surprised that the result would be even lower growth and inflation? Well, I think the surprise is because of the difference that most people point to and really kind of get stuck on is consumer prices. They think that because consumer prices zoomed ahead in 2022, that somehow represented an inflationary inflection, when it really wasn't. That was just a simple economic response to the imbalance between supply and demand. What was different about the early 2020s was the lack of supply elasticity. Supply was heavily restrained. It wasn't inflation. It was simply a supply shock. So when you take that away and look at it long run, you've got the 2010s that are bad. You got something bad happened in early 2020s, and we're heading back after all of these distortions that tend to be normalizing. After all those tend to normalize, we're back into the same big picture paradigm where you have lower growth and lower inflation expectations than we had in the 2010s.
Yeah, it's sort of like the global economy has cement shoes on, and we can't. And we tried in the 10s to do it with monetary policy, just tried with fiscal policy, and all of it masks some of it, but it doesn't actually solve the problem. So
I'm just sorry to interrupt, Meg, but that's why are we seeing government after government after government replaced? Because in the 2020s, people realize that even if they don't know the macroeconomic statistics or they don't know the charts and see GDP that goes sideways, they can feel the results of that. They can feel it even more this time because they know they've been impoverished. I think that's the real overriding point for the 2020s. You had the 2010s economy, and then you impoverish everybody by the price changes that happened in the early part of this decade. And you can't just impoverish people and expect it to go well. I don't know why people think that's the case. Yeah, I know government threw a lot of money at it to try to smooth over all these problems, but you can't just impoverish basically the entire world and expect the economy to come out the other side of it squeaky clean and fine. Yeah, but that seems to be the dominant narrative that, governments did it. They found the right way to interject just enough money into the economy and redistribute what was needed to be redistributed to keep it from falling off. Well, the economy didn't fall off in terms of output, but it did fall off in terms of purchasing power of consumers and businesses. And that's what they're pissed about, because people know they've been impoverished, and they know furthermore, there's no way to get that purchasing power back. They can feel the weakness in the economy, and they know they've been closed off from any chance of being made whole. And they're taking their anger out on politicians who refuse to admit the truth here.
Yeah, collectively everywhere, as you point out.
Yeah, and it's not partisan either. Look, it's right. Left, it's right. It doesn't matter. I mean, New Zealand's a perfect example. You had a left-leaning government in New Zealand. It was one of the strictest governments in terms of COVID and the lockdowns and everything in 2020, in the early 2020s. They were unceremoniously dismissed. What was it, 2023, somewhere in there, and a new government on the other supposedly right wing comes in. And they take over and, promise they're going to do everything different. They'll be more business friendly. What happens? Fast forward to today, that same government, this right-leaning government, is unpopular as the left one was before, because New Zealand's economy is an utter disaster. And so the government, it doesn't matter what side of the aisle you're on, they haven't been able to address the economic deficiencies. And so voters are pissed. They're saying, okay, we brought you in to fix this and you're not fixing it. So we're going to replace you with somebody else. The UK is another example. You had the conservatives or nominal conservatives that were in power for over a decade. Last summer, they were thrown out by the Labor Party. Now the Labor Party is as unpopular as the conservatives were because nothing has changed. It's not really a partisan political issue so much as it is nobody really knows how to answer these questions, let alone craft solutions to them.
Yeah. Well, we have, the Trump administration coming in and moving fast. And some people have applauded the at least dynamic nature of the fact that they're trying to, do something drastically different, for lack of a better way to phrase it, and hoping that their pro-growth, pro-business policies, cutting the deficit, all of this will somehow sort of jumpstart the patient. Does it feel like that is a step in the right direction, or are these problems so deep that they need a global solution? Because we're I don't know if you agree, but the global economy may be synchronized, but it looks like from a political point of view, there's a push for deglobalization and trying to address your own problems internally rather than come up with a global solution.
Yeah, deglobalization is a symptom of the fact the economy stopped growing in 2008. It's simply, every man for themselves. If the rising tide is not lifting every boat, then let's just look at home first. Let's take care of our own, because we just don't have the same type of benefits to a globalizing world that we had before 2008. Before 2008, it was easy to embrace globalization because everybody was winning. Yes, it wasn't even. There's always unevenness in any type of free market situation, but everybody was benefiting. Prosperity was building. So, even though we hate our neighbors, we're going to get along because we're all getting rich doing so. You take away that economic growth and opportunity, suddenly it's okay. We're going to go back to looking and take care of our own. That's understandable. And historically, when we go through these globalization periods, there's always a period of deglobalization afterward for very obvious reasons, because we are tribal, we are nationalistic. And when the rising tide isn't rising, okay, let's see what we can do for ourselves first. So the real question is, okay, yes, the Trump administration has come in and it has promised to be very different than the Biden administration. And if the problem was the Biden administration, then that would solve the issue. But the problem wasn't the Biden administration. It's the overarching economic conditions, which has nothing to do with governments one way or the other. That's a point, the offshoot point of what I was trying to make here, is that it doesn't matter what side of the aisle you're on. Now, personally, I believe that what Trump is doing with some of the governments that are becoming more pro-business friendly, which remains to be seen if that's the case, that's a step in the right direction, but it doesn't solve the underlying problem. It sort of removes some of the additional harm that was put in place by certain policies under previous administrations and previous governments. The Biden folks didn't break the economy. However, in some ways, they did make it worse. So Trump can remove some of that harm and maybe make it less worse, but it doesn't remove or doesn't fix and solve the underlying economic issues that go back to 2007 and 2008. Which is why we keep swinging back and forth, not just in terms of people's perception of the economy, but also from one side of the partisan divide to the other, then back again, because nobody can put their finger on the problem and craft a solution that actually takes care of the issue.
Yeah, are there solutions?
Yeah, there are solutions. And I think one of the things you want to talk about is one of them. Look, we have a broken monetary system that broke down in August of 2007. It's never been fixed. And nobody even knows it's broken because everybody's been dazzled by QEs and Fed policies and fiscal stimulus and everything else. And so nobody stopped to look at the original sin. And by the way, if you can see the sideways economic growth in all the charts for the 2020s, you can really see the inflection in everything in 2008. How does that happen? What happened in 2008? It wasn't subprime mortgages. So if the original problem wasn't subprime mortgages, in 2008 shows up as an inflection on every single chart everywhere around the world, at the very least, you should start thinking, okay, what happened in 2008 that would cause something to completely reorient the global economy? Maybe something like a global monetary crisis would be able to do something like that. So we have this original problem that for almost 20 years now, everybody's been looking in the other direction because they don't really know what to think about anything. And they get all of their information on the economy, the financial markets, the state of the monetary system from whom? The Fed, central bankers whose job is to tell you how great a job central bankers are doing. So if we have a problem where central bankers fail spectacularly, the last people are going to tell you about it are these people. Yet these are the people that we all depend upon to tell us how everything is operating. When you look at it that way, things really start to make sense.
What broke from a monetary
The entire
Right.
monetary system, the way the monetary system worked, stopped functioning in 2007,
So
August 9th
the
of
way money's
2007,
moving
the whole
around
thing
the
worked.
world, the way credit's flowing.
The credit does not flow in the same way it does because banks no longer, I mean, the banking sector, contrary to popular perception, the last 17 years has been a nightmare and disaster for the banking sector. You look at bank balance sheets, they have not grown, have not expanded. Many of them have actually shrunk. The problem with that is, while they were doing really dumb stuff up until 2007, in some ways we needed to do not necessarily the extreme dumb stuff, but we needed them to take lots of risk to expand their balance sheets and activities to make sure that credit was created and that it would circulate through the global economy freely and efficiently. That's what banks actually do. They intermediate. And when they're functioning and they're functioning well, you have the credit creation and intermediation that allows credit and money to flow everywhere that it needs to flow so that we can take advantage of all of these innovations and structural benefits and positives that we were taking advantage of in the 80s, 90s, and up until the 2000s. You take away the banking sector, you take away the money creation, and most importantly, it's not really about money supply as it is circulation. That's what banks do really well. They redistribute money throughout the entire global economy so that funds that are trapped over here can find a productive outlet way over here on the other side of the earth. But if you don't have a functioning intermediation system, then you've got funds that are trapped over here doing nothing. So instead, they'll just buy safe and liquid government bonds when they could really be used over here to finance a productive activity like building a factory or hiring a bunch of workers. That never happens. And so you have all of this money that gets trapped and doesn't flow the way it used to. It gets trapped into things like government bonds that actually make it worse because now you're financing governments who feel they have to do more. And let's face it, governments are absolutely awful at trying to allocate resources. So you give governments more resources to allocate. The more they allocate resources, the worse it actually makes everything. And so you get locked in this perpetual Japanification where nothing seems to work because we still haven't solved the original problem.
And is that money not flowing and just sitting in bills, government bonds, because it is mandated, or because the banks themselves have become so risk averse after, nearly blowing up, or a combination of both?
Yeah, it's the banks. The risk aversion started right from August of 2007, long before you got to Dodd-Frank and Basel III and Basel III.5 and the Basel Endgame and everything else that's been coming up along the way. The LSR and all the ratios that came in afterwards, those simply codified what banks were already doing. And it was really just a public relation effort by the governments and international organizations to basically calm the public and say, yeah, we'll never have another 2008. Well, that was already solved in 2008. The problem is the banks don't operate the way they used to because they've seen what you can no longer unsee, which is before 2008, everyone assumed that risks were incredibly low, that the adoption of quantitative techniques had solved the ages-old problem of finance, which was we can quantify, measure, and therefore monitor and respond to risk, which you never can. We can't remove the human element, which is that greed and the ability to rationalize and fool ourselves. We're going to take more risks than we need to, and you're always going to get into a bubble type of end state. And once you go through the bubble type of end state, you need to kind of stop and reset and reform and start all over again. But ever since we had that bubble end state in the middle 2000s, we never reset. We never reformed. The Fed and the ECB and everybody threw a bunch of QEs at it. We had stimulus from the governments. They kept trying to go back to the way things were rather than realizing they need to reset and start all over again. So that's what we're really waiting for. We're waiting for that reset effort, the reform effort, to get everything into a more stable and steady state that we can start to begin to move forward from there.
So this relates to the question I sent you because I'm always thinking about the Eurodollar system that no one controls and that sort of, that sort of effect. And I sent you an email saying I've been thinking a lot about stablecoins and wondering if stablecoins are like the digital version of that same kind of monetary system, or there's some kind of corollary there. Like, is Tether the new Eurodollar system? So are we seeing the growth we are seeing in digital assets in things like stablecoin, like Tether or like USDC? Is that an attempt to kind of like override and find a way around a traditional financial system that's just too paralyzed by counterparty risk and the unknown to actually operate properly?
Absolutely. That's what digital currencies are. Now, set aside Bitcoin for a second, but digital currencies were a response to this monetary need. I mean, the broken Eurodollar system doesn't provide the same capacity that it used to. And so you have this organic free market process that has sprung up. Even if it's not, it's not a top-down centralized blueprint. Let's follow some kind of plan to success. It's experimentation on an individual organic level of trying to solve this same problem. We don't have monetary and credit flow in the same way. So let's see if we can invent some ways to do it. Not that somebody set out to do that, but that's the organic process, and the thinking that goes into it is let's solve a problem that exists, even if we're not really sure what the entire problem is. And so stable coins are in many ways, they're not a new Eurodollar system. They're an extension of it into the digital age. We've been moving toward a ledger money system for hundreds and hundreds of years. We've been moving away from store value money into more flexible mediums because in a dynamic, specialized economy, you need money to be mobile. Think about it today. Commerce today is done at the speed of light. Essentially, you can go on Amazon and buy anything from anywhere in the entire world, and it gets delivered to your door. And payment is done at the speed of light, right? The merchant knows they're going to get paid right away. They don't have to wait for cumbersome forms of payment. You don't have to wait for somebody to ship you gold coins and hope that they actually arrive.
Which is literally what's happening right now. By the way, there's this very odd thing with physical delivery of gold that's kind of messing everything up. If you haven't watched my conversation with Noelle, she's been tracking it, Noelle Atchison. But there are odd things, like crazy things like lorries full of gold running around London. It just seems so antiquated, like some kind of old heist movie or something.
Yeah, and there's a lack of capacity to do things in the traditional sense. And so they got all of these odd, well, not necessarily odd, but you could call them quasi-money solutions, because quasi-money always shows up during periods of tight money, because human beings are innovative. And if you have a major problem that has a tremendous opportunity in solving that problem, people are going to do it. The old idea of wooden nickels. Where did wooden nickels come from? They came from the Great Depression, where you had people who were trying to solve a monetary shortfall by creating their own forms of tokens, some form of medium of exchange that could function and flow in the absence of the traditional form of finance. That's all stablecoins are. But in many ways, to me, they don't represent enough of a step in further evolution in the process. They're essentially an extension of the existing system into a new format. So a stable coin is really nothing more than a money market fund with a tradable token attached to it. It has a reserve of assets just like a money market fund does. It's usually repo, commercial paper, all this type of short-term instruments you see in a money market fund. There's some other stuff in there as well. And we don't really have enough transparency, but overall the idea is the same. So you have money market funds that create a stable value, but also have tradable tokens that make it a medium of exchange, not strictly a means of saving in the short run. It's an elegant solution to what the current problem is. And in many ways, it just extends the current system and gives it a little bit more life. But the positive benefit of it so far is it's been able to get into parts of the global economy that so far the Eurodollar's malfunction had been completely freezing out of it. Because in the current Eurodollar malfunction era, everybody wants to stick to safe and liquid. Safe and liquid usually means the biggest companies, right? We don't want to take risk on some small startup way down in Africa somewhere, or Southeast Asia, where stablecoin adoption is really flourishing at the moment.
Yeah, that's right. Yeah.
So stablecoins have come in and said, look, we can link you to the traditional financial system through these cryptocurrencies. Yeah. So you have access into the wider world in a way that you didn't have access before. Again, it's a medium, not a store of value. The store of value is simply because there's a lot of mistrust about fiat currency and government currencies. There's also problems with Bitcoin. Bitcoin's price is a huge impediment to adoption in a payment medium, because you can't trust that the prices. First of all, the price goes way up. To join the Bitcoin system now means you have to put up a lot of money to get into it. It's a huge entry fee. And then you have to worry about whether or not we go through another Bitcoin winter, which collapses its value. So the volatility of Bitcoin's price is a huge impediment to Bitcoin adoption and taking this payment function, where stablecoins arose in part as a solution to that problem. We'll take away the volatility in price. And so it allows for the underserved parts of the global economy to suddenly be connected to the global economy and financial system in a small way that at least shows that there's progress being made in solving these issues. The overriding systemic issue is about whether or not these can be scalable fast enough to create more of a better alternative and a legitimate alternative to the current arrangement.
Yeah, it's so interesting, and I talked to I just did a podcast called Evolving Money. It's funny that you talk about this as a evolution of how we use money, because that's exactly the lens they took, and we talked about stable coins and the sort of efficiency of them as a payment system, and it was really interesting, and the use in these places that are froze out, like you said, and that got me thinking a lot about this. Two questions people have come to me with and hit me with on this stablecoin thing issue. First of all, a couple people pointing out the connection with Treasuries. You mentioned they hold collateral, usually short-term paper, T-bills. Is this a source of demand for U.S. Treasuries that's underappreciated that we should be paying more attention to? That's sort of what people have alluded to, that while we talk about international investors moving away from Treasuries, reducing their purchases of Treasuries, you have this stablecoin universe who are constant buyers of them because it's the peg they use.
Well, that's part
do you
of
give
it.
that any merit?
Yeah, there's a misconception there that that foreigners are moving away from treasuries. Certain governments are doing that, but actually the commercial system is not. In fact, the commercial system is buying tons of treasuries and is willing to continue to buy treasuries, as evidenced by the price of treasuries, regardless of the level of issuance. So I think we have to always be careful in these settings where you think, oh, the Chinese government is moving away from treasuries. Well, the Chinese government is being forced to move away from treasuries for a variety of reasons, but that doesn't mean the Chinese system, the Chinese commercial system is overall. We can't look at China as some monolith that's just China. Sure. So the Chinese government might be moving away from treasuries, but the commercial system still needs access to the dollar system. So they're still buying treasuries left and right. And that's true of countries around the world. So you take hostile governments like Brazil, for example. Brazil, they say they don't want to move away from the dollar. They want to move away from treasury. They want to move away from it. But functionally, they can't, and they're not. So the idea that the world is moving away from treasuries is simply false. There are special cases where certain parts of the system are moving away from treasuries, but that has nothing to do with usually what's being talked about, that they're trying to replace the dollar. It's usually the dollar system that's forcing them to liquidate treasuries to alleviate a shortfall in actual funding. But there's tons of different pockets, different reasons to own treasuries that include stable coins and other types of money market funds. Why do we have so many money market funds? Where do money market funds put their proceeds? They invest in usually short-term bills and things like that too. Mm. So if stable coins are an extension of money market funds, it's just another pocket of demand for the same type of safe and liquid instrument.
The other thing that's been suggested to me is that if the U.S. now we have an administration that seems to be more open to the digital asset world, to all things crypto, that you've got people in positions of power whose companies are involved in this, not just Elon Musk, but also Howard Lutnick. They clear a lot of the clearinghouse for stablecoins, that if the U.S. embraces stablecoins, it will just extend the dollarization of a global economy as opposed to the opposite. Do you give that any merit?
Yeah, absolutely. Because one of the things, if you talk to anybody in the stablecoin business, and I was a trustee of a stablecoin for a while, so I had a little bit of insight into this too. If you talk to anybody in the business, their primary complaint isn't necessarily regulation; it's the lack of regulation. Because a lot of stablecoins, let's face it, a lot of stablecoins are junk. There's a lot of scams out there, which is true of any disruptive technology. It's always going to attract scam artists and fraudsters. That's going to happen.
And that's a lot part of the growing lack of transparency.
Yeah, that's one thing that really needs to be worked on. But there are a lot of honest stablecoin projects out there who are really attempting to solve these very big issues. And they're saying to governments, look, we want to work with you. We want to work within the parameters that you set out. But in order for us to do that, you've got to actually set out parameters for us so that we can meet your regulations. And for the longest time, regulators have been delaying this by just not giving regulations. Or they'll say, we're going to move in one direction where we want you to do this. And then the next week they'll say, oh, no, we changed our mind. We want you to do this. There is no stable, irony, really pun intended here, there is no stable regulatory regime that a lot of these coin projects can actually operate within. When a lot of them actually want to do it, they want to be regulated. Yeah. They want to project what stable coins are supposed to project, which is safety. They want to be a medium of exchange that is useful and dependable so that people can feel good about using them. And part of that is, look, we're willing to work with governments, but most governments have not been willing to work with them because, first of all, they don't understand digital currencies and what they're about. And secondly, they perceive them as a threat to their current power paradigm, which they don't really have anyway. So up until recently, certainly in the United States, it's not true around the rest of the world. As we said, there's lots of places where stable coins are flourishing. But in the United States, the regulatory regime has been incredibly hostile. And it hasn't been they're trying to regulate stable coins out of business. They haven't been regulating them at all. They've been trying to keep everything in an arm's length. So a change in the Trump administration toward a more, even just saying we're going to set out a bunch of regulations would be a huge positive for the U.S. ability to lead the stablecoin revolution, which so far it's actually been outside the U.S. more than anything else.
Yeah. Do we have a situation where, so we've got a financial system that's broken. There's, at least from a payments point of view, people are organically looking to get around that, a workaround using things like stable coins. Does the answer, do you think, lie in this sort of next, it's somehow in the digital asset, digital money, cryptocurrency space? And are traditional banks a part of that? Do they just move in there to fix the system, or are they left out in the cold and new players come to kind of rebuild a system that works? Because it seems like it's going to have to happen otherwise we're going to be stuck in a zombie no growth situation in your mind permanently, unless we somehow address the root cause, which is the broken financial system.
Yeah, there's a whole bunch of questions there.
They're really big ones.
No, there's a lot of big.
In 1 minute.
That's the thing. In the disruptive technology, a period of disruptive technology, it's very difficult to, details. It always looks messy because the current power players never want to give up their power. It may not ultimately be up to them, but it's not easy to see that that's the case while it's all unfolding. If you go back and look at the big picture again, the evolution of medium of exchange moving toward ledger money for a long period of time, you can see what are different stages, although they're not brightly defined stages. They're always blended. You can see different stages. The first stage was simply banks adopting what people today take for granted, which is deposit money, which is a form of ledger money, simply to make it more mobile. So you had a bank form of ledger money that developed in small scale networks. And then they started to be put together in larger networks, sort of decentralized. We had a correspondence system in the United States in the latter half of the 19th century. That was a really elegant way to adopt a mobile medium of exchange where money could really move from one side of the country to the other as it needed to do as the economy increasingly grew. And then after that, you had the second stage of that evolution was adopting that model in an international framework, which is what the Eurodollar was. Mm-hmm. And in both of those stages, it required banks to participate because banks were the only institutions that had the capabilities to create these interlocking ledgers that work together. So the third stage of the evolution from a very big picture sense would be to not have interlocking ledgers, just have a single ledger. And if we have a single ledger, we don't really need the bank bookkeepers to keep all the books for us. So in a very pure evolutionary sense, the next stage, how we get there is completely up in the air, but the next stage should really be without banks entirely. We don't really need banks. We don't need central banks. We don't need banks. Now that will require a huge amount of radical transformation, which is going to lead to a whole bunch of, difficulties, obstacles, political fights, because banks are not going to go quietly. They love the privilege that they've attained by being the ledger system up to this point. They're not going to give it up. So there's a lot of stuff that needs to be settled. But from a purely evolutionary standpoint, the next stage in the evolution of ledger money is to have a single ledger that is completely decentralized, that doesn't require the banking system to keep the books, nor really to be regulated and monitored by them through an intermediation function either. Intermediation can be done by anybody. We don't need specialized institutions.
This is blockchain, right? I mean, everything's is technology.
That's what decentralized finance is. You could have smart people who are really good at allocating resources. Just pay me a fee and I'll figure out where to put your money, right? We already have a financial services industry. We don't need to put it inside a formalized banking structure. Yeah. But in transforming from the world that we have to that world in the future, there's a whole lot of things that need to be settled and sorted out first.
A whole lot of mess we got to get through.
Tons of mess.
So this was so enlightening, and I think really connects the two worlds that we talk about all the time that seem so different and tribal, For people who are really in the blockchain space and see the potential, and people who are in traditional finance, there seems like there's so much tension. But I think this conversation, I hope, opened up some eyes about how interconnected they will increasingly become, which is why I think we have to kind of stay abreast of both of them. So until we get there, though, it sounds like based on what you see, we have subpar growth, angry citizens, bond interest rates that are low because they just simply not going to move higher because we don't have the demand, the growth that suggests it. What about the dollar and stocks?
Well, stocks, like I said, until the stock market encounters what looks like a traditional recession, they're free to go. I mean, the stock market, there's no fundamentals in stocks. Stocks are exactly what John Maynard Keynes says is a beauty contest. If everybody thinks that everybody else thinks that stocks can go higher forever, then they can go higher forever. It doesn't really encounter a problem until they're forced to liquidate by some financial event or something else. So stocks, what everybody's looking at in the stock market is what we said at the first part of this interview, is that if you don't see negative GDP, if you don't see negative payrolls in the U.S., then the economy's fine. Let's just keep going with it. So stocks can go on who knows how long. I mean, no idea how long they can continue to go.
Right.
There's no way to predict that. As far as the overall economy, Meg, I think you got it right. We're kind of stuck with what we have for now, because as much as there is promise in a digital currency future, it is, iterations away from being in any kind of a final format. There's a lot of things, like we said, that need to be worked out, not just in terms of big picture stuff, but also the minute details. It's not so easy just saying I'm going to have a stable coin start to, transfer money from back and forth around this part of the world to that part of the world. Yeah. And which kind of stable coin are we going to use? There's all sorts of different ones. Tether's the biggest one, but there's all sorts of smaller competitors that may be able to do it better. So there's lots of big picture details, small picture details that need to be hammered out, scalability issues, which are huge. If we're going to talk about replacing the Eurodollar, which is what we should be talking about, you have to replace every single function that it provides. And though it is not providing them at maximum capacity, some of these functions are incredibly difficult and resource intensive. So there's a long road ahead. And while we're on that road, that's positive. We're stuck with what we have. We're stuck with angry people, an economy that doesn't grow, people that don't know the economy isn't growing because GDP is positive and payrolls are positive from month to month. They don't realize the massive deficit, but they know something's wrong. We're kind of stuck with it until we get to that point where we can hand off into something better.
And the dollar's not going anywhere.
It can't. That's the thing. As much as people hate it and they hate the idea of it, it's the medium that works. It's the one thing that actually does, it keeps the lights on at the very least. So it doesn't function the way we need it to, but it does function at minimal capacity. And that does mean that other governments, places like India's trying to internationalize the rupee. By the way, there will not be a BRICS currency. We need to let go of that idea because it's stupid to begin with. There is no BRICS currency, but that doesn't mean that India is going to try to transact on a bilateral basis in more places that it can, because it has trouble accessing the dollar. Just look at the rupee's exchange value. We're stuck with the dollar as the background international currency because there is no alternative. That's really the only thing that keeps the dollar in place, is the fact that there is no alternative, and there is nothing even close to being one.
Amazing stuff. And I, as usual, Jeff, I'm going to have to walk away and think about this for a long time. But I think that you touched on some really important points that hopefully will break some people out of their echo chamber, because kind of people have an idea or narrative that they're married to. And I think it's really important that we kind of try to see through all of this when we're talking about it, because it's super complicated stuff. Thank you so much, as always.
My pleasure, Maggie. Always great to see you.